Good day, ma'am. Good day, classmate. Our presentation for today is all about managing checking and savings account, Module 4, presented by Group 4. This is our team, Jinky Saringan, Freddy Legaspi, Johan Carl S. Billones. This is our summary of discussion about Module 4. What is monetary assets management? Open checking and money market accounts, establish ownership of assets wisely, electronic money management, the psychology of money management.
What is monetary assets management? Monetary asset management encompasses how you handle all of your monetary assets, including cash on hand, checking accounts, saving accounts, and certificates of deposit. And money market accounts, the goal is to maximize interest earning and to minimize risk while keeping funds safe and readily available for living expenses, emergencies, and saving and investment opportunities. Success monetary assessment management allows you to earn interest on your money while maintaining reasonable liquidity and safety. Liquidity refers to the speed and ease with which an asset can be converted to cash. Your funds are safe when they are free from financial risk. The three tools of monetary asset management, as illustrated in Figure 5.1, monetary assessment management relies on three major tools. The first one is low cost, interest earning checking account from which to pay ongoing current living expenses. The next one is interest earning savings accounts in local financial institution in which you deposit funds for upcoming expenditures or to accumulate funds for future investments. 3. Money market accounts in local financial institution or other financial services providers. These accounts pay higher interest rates than checking and savings account. They have limited check writing privilege and thus are the cross between a checking and a savings account. Who provides monetary asset management services? The financial services industry comprises companies that provide monetary asset management and other services. The firm in this industry provide checking, savings, and monetary market accounts. Quite often, they also provide credit, insurance, investment, and financial planning services. These firms include depository institutions such as bank and credit unions, stock brokerage firms, mutual funds, financial services companies, and insurance companies. Depository institutions. Depository institutions are organizations licensed to take deposits and make loans. They all can offer some form of government account insurance on their customers. Depository and are government regulated. They offer a wide range of financial services. Example of depository institution and commercial banks, saving banks, and credit unions. Although each is a distinct type of institution, people often call them all simply banks. Other financial services providers. Other providers offer monetary assessment management services. Most purchase private insurance to cover potential losses in their monetary assessment account. No insurance is monetary asset account. No insurance is available for stocks, bond, and other investment accounts. The first tool is interest earning checking accounts. A checking account at a depository institution allows you to write check against amount you have on deposit. Checks transfer your deposited funds to other people and organizations. Checking account also can be assessed by using a debit card in an automated teller machine or a point of sale terminal at a retail store. When you s- when you use a debit card, funds are instantaneously removed from your account. They are given to you as a cash or sent electronically to an account owned by any other person or organization you designate to receive the funds. You can also access your checking accounts via telephone or home computer. When you use a checking account, record the date, check number, amount of the check, and to whom it was written into a check register who received when you obtain your blank checks. All subtract the amount of the check from your previous balance in the account. Deposits into the account are added as they appear as well. This section examines the types of checking accounts available and checking accounts charges, fees, and penalties. The second tool of monetary asset management is a saving account. A saving account provides you with a readily accessible source of emergency cash on a temporary holding place for funds in excess of those needed for daily living expenses. Interest rates on saving account are typically 0.20 to 0.50 percentage points higher than those paid on interest-paying checking accounts. Funds on deposit in a saving account are considered time deposits rather than demand deposits. Time deposits are saving that are expected to remain on deposit in a financial institution for an extended period. Institutions have a rule requiring that saving account holders give 30 to 60 days notice for withdrawals, although this restriction is seldom enforced. Some time deposits are fixed time deposits with specify with a period that the saving must be left on deposit, such as 6 months or 3 years. Certificates of deposit fit these descriptions. The last tool is money market accounts. Most people use checking and saving accounts as the cornerstone of their monetary asset management efforts. When income begins to exceed expenses on a regular basis, perhaps by $200 or $300 each month, a substantial amount of excess funds can quickly build up. Although this situation is a comfortable one, it is wise from a monetary asset management point of view to move some of the excess fund into an account that pays more interest. A money market account is any of a variety of interest earning accounts that pays relatively high interest rates and offers some limited check writings privilege. A money market account provides both checking and saving tool at a higher interest rate. Such accounts are offered by banks, savings banks, credit unions, stock brokerage firms, financial services companies, and mutual funds. The types of money market accounts are super now accounts, money market deposit accounts, money market mutual funds, and asset management accounts.
Money Market Mutual Funds. A money market mutual fund (MMF) is a mutual fund investment company that puts investors' cash for a safe, high return by buying short-term debts with daily interest calculations, allowing investors to withdraw funds at any time. Asset Management Accounts. An asset management account (AMA) is a comprehensive package that consolidates various financial assets into a single account, allowing customers to conduct all their financial transactions with one institution, including money market funds, checking, credit card, debit card, loan and stock brokerage accounts. Electronic money management. Electronic money, a form of money in banking systems, is primarily used for electronic transaction due to its convenience and backed by fiat currency. How electronic money works. Electronic money is a global currency used for transactions, primarily through electronic banking system and monitored through electronic processing, with a majority housed in bank vaults and backed by central banks. Special considerations. Currency in circulation electronic money is stored in various locations, including banks, prepaid cards, and digital wallets like PayPal and Square. Companies charge a percentage on withdrawals or conversions from electronic money to fiat currency. Many Americans process transactions electronically in a multitude of ways. This includes receiving paychecks through direct deposits, moving money from one account to another via electronic fund transfers, or spending money with credit cards and debit cards. Physical currency role has diminished over time, with electronic money becoming more secure, convenient, and widely accepted. The U.S. financial market has established a robust infrastructure for electronic money transactions. Banks and financial institutions collaborate with electronic money networking processors to issue branded network cards for electronic transactions, enable convenient online shopping for goods and services. Using plastic in monetary asset management. There are many types of plastic devices used to access your money. Number 1. ATM cards enable money transfers between checking and savings accounts using a personal identification number PIN at an automatic teller machine. Number 2, debit cards offer a convenient method for purchasing at retail outlets, transferring money from your account immediately, typically requiring a PIN or signature. Number 3, stored value cards, like gift cards or refund cards, are mini checking accounts with a magnetic strip or barcode and can be reloaded with additional features like Walmart's Visa debit card. Number 4, electronic benefits transfer. Cards are utilized by the government to pay military personnel and provide social security benefits, unlike stored value cards where the holder loads the card. Number 5, credit cards allow you make purchases or obtain cash with credit from the bank or retailer that issued that cards. These are debts that must be paid back, often with interest.
The psychology of money management. When we say psychology of money management, a common cause of tension in personal relationship is conflict over money. Some people seem unable to work together to perform even the fundamental tasks of managing money, such as reconciling the checking account, creating a workable budget, and paying bills on time. Managing money and making final decisions are different. Managing money includes such tasks as handling the checkbook, overseeing the budget, and doing the household shopping. Couples should agree on who will carry out this day-to-day course and then carry throughout the responsibility. Financial experts recommend that each person in a relationship keep some money of his or her own. People ascribe strong emotion to money. People often ascribe a number of emotions to money, including freedom, trust, self-esteem, guilt, indifference, envy, security, comfort, power, and control. They bring with them the patterns, beliefs, and attitudes that were prevalent in their family of origin. It's essential to recognize the importance of this emotion. Many people want to hold on to their fiscal autonomy as long as possible, and they may be embarrassed to inquire about how much others even love, want, spend, earn, or owe. For many people, money is an area of suspected incompetence. How to talk about financial matters. Discussion about money matters are not always easy. So, this is a top 5 talk about financial matter. Number 1 is get to know yourself. The first step in learning to talk with others about financial matters is to understand your own approach to money. Consider the emotion described earlier to help get you started. It is constructive to discuss any difference in how you view yourself as compared with how your partners views you. Focus on commonalities. Successful communication about money requires that the effort be aimed towards agreeing on common goals and reaching a consensus of opinion without substantially compromising the views of others. Learn to manage financial disagreement. Give all family members time to express their views when discussing financial matters. Each also needs to listen to what others are saying and feeling. If talking proves too difficult, have each person separately write down his or her concern. By swapping notes, ideas and concerns can be shared. Schedule a time and place for financial talks, decide on agenda items, and leave other conflicts outside the door. Use positive I. Statement message focusing on I describe the behavior in question. The poor feeling you experience because of the behavior and any tangible effect on you. For example, a spouse might say, I feel upset when we use credit card because I do not know where we will find the money to pay the bills at the end of the month. Using I message helps build stronger relationship because they tell the other person, I trust you to decide what change in behavior is necessary. Be honest and talk regularly. Achieving consensus requires that each person be honest when talking about matters. It further demands that couples regularly talk about finances. Be prepared to compromise. When you make decisions together, act on them. Focus attention on both current financial activities and issues as well as long-term financial planning. Use this discussion to forge overall long-term strategies for dealing with your family finances. Once the proper base has been established, short-term issues are more likely to fall into place.